This evening, small savings schemes will now fetch you smaller returns. The government has handed some sharp cuts to small savings in a bid to align them closer to the market rates. So let's take a look at the details now. Public Provident Fund, or the PPF, will not fetch you an interest rate of 8.1%. Will now fetch you an interest rate of 8.1% against 8.7% earlier. The Kisan Vikas Patra has seen the interest rate slashed by a whopping 90 basis points. The one-year time deposit rate has seen an even bigger cut of 130 basis points. In fact, rates have been cut across the board from the one-year deposit to the five-year deposit. Not just that, the popular five-year National Savings Certificate will now fetch you an interest rate of 8.1% against 8.5% earlier. The interest rates on Senior Citizen Savings Scheme and the Girl Child Scheme have also seen cuts. The government has done its bit, though, to try and allay fears, fearing a backlash, just like they saw on the EPO tax. The government coming out to clarify. Economic Affairs Secretary Shaktikanta Das reiterating that this is not a cut, it's a reset, it is a recalibration, given the way that GSEC yields have been moving. Listen in.
From the year 2012-13, the interest rates for various small savings schemes are reset every year in the month of March for the next financial year. This is being done following the recommendations of the Shamla Gopinathan committee. This is a normal process which is going on from 2012-13. Following the same process, this year also the interest rates have been recalculated with reference to the GSEC yields of equivalent maturity. This time, however, as you know, in the month of February, earlier the government had issued a press release saying that in the 1 year to up to 5 year instruments, the additional interest rate spreads will not be allowed, but 5 year and above, you know, the various schemes like your NSC or the PPF or the senior citizen scheme, whatever additional interest rate spreads were there, that are being allowed. In other words, let me just again summarize. This is a normal process which is done every year in the month of March, and as done in the previous years, this year also the interest rates have been recalculated and have been notified today. The only change is earlier the rates were notified for the entire financial year, the following year. Now the interest rate which has been notified is for the next quarter, that means the first quarter of 16-17, and this has been done by taking into account the GSEC yields of similar maturity for December, January and February. Based on these 3 months actual rates, the rates for the first quarter of 2016-17 have been calculated and notified. The rates which have been notified also include the additional interest rate spread which government allows for certain schemes like Senior Citizen Scheme, Sukanya Samriddhi Scheme and PPF, etc. For example, let me say we give 100 basis points additional spread for Senior Citizen Scheme. In other words, there is a markup of 1% interest rate for Senior Citizen Scheme, 0.75% markup for Sukanya Samriddhi Scheme, 0.25% interest rate markup for schemes like National Small Savings Certificate, the monthly income scheme and the 5-year time deposit scheme, etc. So therefore, the interest rate reset that was announced today is following the normal practice which is in existence for the last 4 to 5 years.
So just one question.
Just because, you know, why this has happened is, if you see the last year, that is 15-16, the average GSEC yield has come down compared to 14-15. In 14-15, the average GSEC yield, that is the interest rate, were about 8.5%, 8.5%, whereas in 15-16, the rates are 7.9%. So there is a 0.6% reduction. Now this is the average, but in various instruments like 10-year GSEC, the interest rate reduction might be little more, or in 5-year period it may be little less. So it varies from GSEC of different maturities. So therefore it's a interest rate reset which has been done as done in the previous years. The additional interest rate markup which is announced, which is being continued for schemes like Senior Citizen Scheme, PPF and the Sukanya Samriddhi Scheme, is also being continued, and it's a normal process. So when the GSEC yields go up, naturally the small saving rates will go up. When the GSEC yields come down, the small saving interest rates are also, they will also come down. This is being done to make the small saving interest rates more market linked, more market aligned, and also this will enable the banks to, consequently reduce their deposit rates and extend loan and credit to the public and to the various, borrowers at lower rates.
Well, that is the Economic Affairs Secretary Shakti Kanta Das. Let's go across now to our colleagues Sapna Das and Lata Venkatesh. But Sapna, to you first. These cuts were expected, but did anyone anticipate such sharp cuts? We've had the economic survey where the chief economic advisor, in a sense, had paved the way, saying the government must move down this path. As the secretary was pointing out, that this recalibration is done on the basis of the Shamala Gopinath recommendations. It's been happening for a few years now, but the degree of the cuts, that seems to be causing the concern.
Absolutely. In fact, nobody had anticipated a rate cut of almost 1% in some of the shorter end schemes. Of course, there's a clear logic to it, and as the Economic Affairs Secretary was saying that, the corresponding GSEC yields with matching tenures at the shorter end of the bucket, they've all actually moved down quite sharply. Hence, the rate cut, rather the resetting of rates over there is sharper. But still, you're looking at a range of 40 basis points, starting from 40 basis points and going up to 1.3%. This is absolutely unprecedented. Generally, before the government had brought in this new formula of trying to make it more market aligned, the last time where you had actually heard of such a hefty rate cut or a hefty resetting of interest rates on small savings was, I think, a couple of years back. And a long time ago, in fact, it used to be around 0.5% for the entire financial year, which was, even on that, there used to be a lot of feedback from, small savers. So this has really taken the wind out of a lot of people. Of course, the saving grace here is that it will be reset on a quarterly basis. So this will only hold true for April 1 to 30th June FY17. But given the fact that bond yields are on a downward trajectory, Mr. Das gave some numbers, like, for example, the average yield is down to 7.9% in FY16 as compared to 8.5% FY15, and also some other yields may be actually lower than that.
Right.
Probably the 10-year paper is trading around 7.6%. So this trend is expected to continue, and keeping that in mind, it's going to be very difficult for the government to actually give any kind of a further markup. In fact, he also clarified that the other tenures, the higher end tenures like your Sukanya Samriddhi scheme, your senior citizen scheme and some other schemes, there the government has actually not touched the additional interest rate markup. Despite that, there is a sizable resetting of interest rates. Kisan Vikas Patra is going to be down by almost 1% from next financial year onwards. Sukanya Samriddhi scheme also down by 60 basis points, and PPF also down by 60 basis points. So, these are quite, sizable. This is sizable resetting that we're talking about, and clearly a signal to banks to, kind of rework their interest rates. Also, probably a signal to Reserve Bank of India that it should do something with the policy rates.
Absolutely. You heard the secretary there saying that it is now up to the banks to act. The government has done its part. The banks will need to reset their deposit rates as well and then move on to further transmission. But the signal to the Reserve Bank is also clear. In fact, let's go across to Lata now. Lata, the rationale behind these interest rate cuts, of course, has been explained here by the government. But the fact of the matter is that this is a loud message, a loud and clear message to the Reserve Bank of India saying, look, we stuck to the path of fiscal consolidation. We've delivered on the fiscal deficit number, and we're now moving the small savings rate more market, making it more market linked, and you better do your job now.
Well, the seminal cut that you have seen across the board between 50 and 130 basis points indicates that the government means business. It's a very strong signal to the commercial banks, but more importantly to the Reserve Bank. What it is basically telling the Reserve Bank is that we have given you fiscal prudence, which means we are going to borrow less. Therefore, Government of India bond yields have come down by about 30 basis points since the budget. And now we are also removing the one hindrance to interest rates coming down, which is small savings rates. They've also been brought down, and the Reserve Bank therefore will be under severe pressure to cut not just one dose of 25, but perhaps a 50 basis point cut. The markets won't wait for April 5th when the Reserve Bank announces policy. Chances are on Monday itself you are going to see bond yields fall in anticipation that the RBI will be under pressure to give a substantial rate cut.
Well, Lata Sapna, we'll have to see how the bond markets react to that. But let's bring you political reactions because the backlash has already started. Sitaram Yechuri tweeting, and joining us now is Randeep Singh Surjewala of the Congress. Mr. Surjewala, appreciate you joining us. What can we expect now from the Congress party on the back of the resetting that's been announced by the government on the small savings rate?
Shireen, it is very, very clear that Modi government continues to hit out at small sections of India's populace, be it farmers. We just saw government tax and then rollback on employees' provident fund. Now now interest rates on public provident fund, also on Kanya Mridhi scheme, as also on other such similar schemes, including Kisan Vikas Patra, have been cut.
Yeah.
Is this government trying to send a message, trying to tell the common man who's already plagued by sagging economy, great rural distress, and recent rains and hailstorms destroying crops in at least a dozen states of North India, that do not even rely upon your savings?
Mr. Surjewala, the government's not here to defend itself, so let me play devil's advocate. The government saying that this is something that happens every year. This is normal practice. The rates are following what is happening as far as the bond yields are concerned, and hence this recalibration. Are you now going to, is the Congress Vice President Rahul Gandhi, he claimed to take credit for the EPF for rollback. Is he going to put his might behind this issue?
Absolutely. Congress party will. On one hand, this government is saying that they will recalibrate and reduce taxation on corporates. On the other side, you are taxing the common man. You are reducing interest on his most sought-after schemes. You are reducing tax on interest rates on schemes like Kisan Vikas Patra, on schemes like Public Provident Fund, which are the only source of saving for the common person in this country. It's actually a direct attack on their saving patron, besides taxing them and not providing any relief to them.
If this were to prompt the Reserve Bank of India to be more liberal in its rate cuts, and the anticipation now is that perhaps this will open up room for the Reserve Bank to cut more aggressively than was previously anticipated, then that's good news overall as far as the economy is concerned.
Well, my simple question to the finance minister would be, why is it that the common and the poor people in this country, the farmer and the small laborer in the country, have to pay for economic reform all the time in this government? Whether it comes to non-grant of appropriate MSP in the name of doing the necessary savings in economy, whether it is cutting subsidies on food and other items, including fertilizers, whether it is taxing ready-made garments or even artificial jewelry, whether it is imposing taxation on in terms of service tax and taxing even the minimum health services, and now reducing interest rate on savings. Is the responsibility only on the common man, and are they going to be so distressed that they will not be able to survive? Then what will we do with an economy, and how will it run?
What will your course of action be, Mr. Surjewala? You can't take this up in Parliament now because Parliament has broken for recess. It will only reconvene in April. In the interim, what can we expect as the course of action?
Well, Congress party is going to take this to People's Court. We will ensure that Prime Minister Mr. Modi and Finance Minister sees reason, and we will also ensure that they roll back this decision like many others they have done in the past under pressure from people of this country.
All right, Randeep Singh Surjewala of the Congress party, not the only opposition party that is taking the government head on as far as this recalibration or cut is concerned. As we pointed out, other leaders like the left, Sitaram Yechuri, also coming out and saying that this is an attack on the small savers on the part of the government. We've got Nalin Kohli, spokesperson of the BJP, joining us. Mr. Kohli, appreciate you joining us here on CNBC TV 18. The political backlash has already started. What is going to be your way of damage control?
No, I don't think it's about damage control or political backlash. We need to understand why it's done. The larger question, which I think you would probably well understand and appreciate, that how are interest rates at the end of the day calculated? They are calculated on the GSEC or the government borrowing rate. Now those borrowing rates have started coming down. Now when it comes to small deposits, which may be like say for those who are elderly, then the government over and above the borrowing rate at which the government borrows the money, it gives a subsidy. So like for old people who are elderly, the subsidy is about 100 basis points. On PPF, it is approximately, if I recall, about 25 basis points. In the Sukanya, it's about 75 basis points. So those subsidies or the subsidizing of those rates which over and above the lending rate what the government borrows money at, those continue unchanged. What has changed is that interest rates, just like say oil prices, are dynamic and those prices come down. Earlier it used to be done on an annual basis. Now it's being done on a quarterly basis. So there's a complete economic rationale to it. It is absolutely in sync with what is happening. The protection that is there for the elderly, for ladies, for other small investors, that subsidy has not been touched in any manner. Since the overall lending rates have come down, the government obviously is going to borrow at lower rates. So therefore, from that perspective, it's only a rationalization. So those who are making a political attack are essentially ignoring the
chance to actually... I'll get you the chance to actually take the attack to the CPI. Gurudas Dasgupta joins us as well. Mr. Dasgupta, appreciate you joining us. Nalin Kohli there saying that this is part and parcel of the resetting that is required on account of the manner in which government securities are moving today, and the subsidy protection that has been provided in various schemes like the Sukanya Samriddhi scheme or for the senior citizens, that remains intact. So what are you arguing about?
It's a dangerous move. It will affect the income of the retired middle class and lower middle class. It will affect the small savings scheme, which is a source of income to the people who have no other way to earn. It will affect the people very much. This is dangerous.
It's dangerous, and you believe that this will have political implications. Nalin Kohli, very quickly, you want to respond to Gurudas Dasgupta on CNBC TV 18?
Certainly. I don't think it's a war situation in any sense that it could be termed with an adjective like dangerous. I think the other part of it is, if you are at one end looking at it, then for retired personnel who are on pensions, those pensions keep getting rationalized upwards in terms of recommendations of various pay commissions, in terms of those like from the armed forces, you have OROF, so one rank, one pension. So things are done. This is part of the overall architecture. You don't look at the economic architecture in such a manner as is being made out to be, that if the government's borrowing rates are lower than earlier, you don't then pay a higher interest, and if they are being rationalized, and when I said the subsidies that go from the government to the elderly, to women, to others, they are not being touched in any manner. So I don't understand how it is being seen as an anti-people's move.
Gurudas Dasgupta, the final response from you to Nalin Kohli before I wrap.
It is not correct at all. It is only a lame excuse in defense of the government. It is anti-people, anti-middle class, anti-lower middle class, and on the whole, it will diminish the rate of social savings in the country.
All right, gentlemen, appreciate you joining us here on CNBC TV 18. As we said, I don't believe that this story is done just yet. There could perhaps be a review, even as far as this decision is concerned, depending on the backlash that in fact follows. But let's move on.